The US dollar, USD, is currently grappling with mixed signals. While dovish Federal Reserve commentary and potential weakness in the U.S. labor market, as indicated by today's JOLTS job openings data, could pressure the dollar, geopolitical tensions in Europe and weakness in emerging market currencies are providing support. In the short term, the USD is expected to trade within a range of 106 to 107, unless the JOLTS data surprises significantly to the downside. However, the long-term outlook for the dollar remains clouded by unfavorable seasonal trends and recent dovish Fed rhetoric. Key factors to watch include the upcoming comments from Fed officials Kugler and Goolsbee, which could provide further insights into the central bank's monetary policy stance. Additionally, ongoing political instability in Europe, particularly in France, and weakness in emerging market currencies could continue to impact the dollar's strength. Given these conflicting forces, the USD's future direction remains uncertain. Traders should closely monitor key economic indicators and geopolitical developments to make informed decisions about their currency positions. The US dollar to Japanese yen pair has recently pulled back after finding support at the 100-day SMA. While a potential short-term reversal signal has emerged, the pair remains in a downtrend on both short and medium-term timeframes. Technical analysis suggests that the pair could continue its downward trajectory, with potential targets at 147.92 and 147.18. The MACD indicator is also signaling bearish momentum. Several analysts share this bearish outlook. UOB Group expects the USD to trade in a range but may continue to decline in the longer term. OCBC also anticipates a consolidation phase for the pair, with a bias towards selling rallies. The Bank of Japan's potential for further rate hikes could also exert downward pressure on the JPY, further contributing to the bearish outlook for US dollar to Japanese yen. The US dollar to Swiss franc pair is showing signs of weakness, with the formation of a bearish head and shoulders pattern on the 4-hour chart. A break below the neckline at 0.8797 would confirm this pattern and likely lead to further declines, with an initial target at 0.8703. In the USD/CNH pair, recent geopolitical tensions and potential U.S. tariffs on China have pushed the pair to its highest levels since July. While there is near-term upside potential, some analysts believe that major resistance at 7.3115 may be out of reach for now. Overall, the USD is showing strength against both the CHF and CNH, driven by geopolitical factors and potential rate hikes. However, technical indicators suggest that the US dollar to Swiss franc pair may be due for a correction. The US dollar to Canadian dollar pair is trading near its daily low around 1.4000, pressured by a combination of factors. Rising oil prices are supporting the Canadian dollar, loonie, while a softer US dollar, USD, is also weighing on the pair. However, the downside appears limited as traders await key US economic data releases. Geopolitical tensions, including the Russia-Ukraine conflict and the Israel-Hezbollah ceasefire, are adding to market volatility. Additionally, expectations of a potential rate cut by the Bank of Canada, BOC, are weakening the loonie. On the other hand, the USD is receiving some support from rising US bond yields and expectations of higher interest rates in the US. However, concerns about potential U.S. tariffs on imports could limit the upside for the USD and the US dollar to Canadian dollar pair. Investors are closely watching upcoming U.S. economic data, including the non-farm payrolls report and Fed Chair Jerome Powell's speech, for further insights into the interest rate outlook. The OPEC Plus meeting on Thursday could also impact oil prices and, consequently, the loonie. The Indian rupee, INR, continues to weaken against the US dollar, USD, driven by multiple factors including Trump's tariff threats. The potential for increased tariffs on Indian goods could further weaken the INR. Foreign fund outflows. Continued outflow of foreign funds from Indian markets is putting downward pressure on the currency. Stronger US dollar, a stronger USD, driven by factors such as potential Fed rate cuts, is making it more expensive for INR to purchase USD. While the Reserve Bank of India, RBI, may intervene to curb the rupee's decline, the overall trend remains bearish. Key economic data releases, such as the U.S. JOLTS job openings and the U.S. non-farm payrolls report, as well as Fed policy decisions, will also influence the U.S. dollar to Indian rupee pair. Technically, the US dollar to Indian rupee pair is currently trading above the key 100-day EMA, indicating a strong bullish trend. However, the RSI is overbought, suggesting potential consolidation before further upside. Support levels for the pair are at 84.55, 84.22, and 83.98, while resistance is at 85.00 and 85.50. The USD/SGD pair has continued its upward trend, tracking the rise in USD CNH. The pair is currently trading around 1.3475. Technical analysis suggests that the pair may consolidate higher in the near term, with resistance levels at 1.3490 and 1.3520. Support levels are seen at 1.3390, 21-day moving average, and 1.3340, 200-day moving average. The Singapore dollar, SGD, remains relatively firm against its peers, but it has shown signs of weakening recently. This is reflected in the Singapore dollar nominal effective exchange rate, $/NER, which is currently 0.86% above its model implied midpoint.